All right, everybody. Hello. It's good to see you all again. I hope you're doing well. I hope this time is treating you well. I'll tell you a story. I worked all these problems and recorded them, forgot to turn on my screen. Oh no. So I'm going to have to work them again and record them, and I will turn on my screen. Um, I hope you all are doing well. So if you see some answers already out there, you can just follow along with me again. All right, so let's go ahead and get started. I'm going to work some of the more difficult practice problems for you for Warner Pacific Practice Week 2. And you can follow along with your Help Me Solve This or my WP classes. All the ones that I'm working, you can work with me because the answers are static. And so therefore, you will not have a situation where our amounts are going to be different in the problem. Your homework might be a little different. So you definitely want to work through these first and then move on to your homework and work those problems. All right, so we'll start with practice problem 2-20. We're going to be looking at the different ratios. And a couple of things I want to tell you about the ratios is the ratios, in my experience, are a great indicator, measurement of how the company's performance uh, matches up to the expectations of management. So, for example, if you were in a board meeting or you were presenting your company's information, it would be a good idea to share some ratios to give the board of directors stakeholders an idea of what you've been up to that year. So these can give you kind of like the financial health of the company. So the first thing we're going to look at is current ratio, and that tells you in how many times your assets covers your liabilities. And it's current ratio, meaning assets and liabilities less than 12 months. So our current assets in this problem is 38.07 billion, and it says in December 2015, Apple had cash of 37.07 billion, current assets of 76.22 billion, current liabilities of 76.09 billion, and inventories of 2.545 billion. So the current ratio is, again, it tells our asset to liability coverage. So we'll take our 2.07 billion at current assets, or I'm sorry, our our current assets, boy, a tough start. 76.22 billion and divided by our current liability, 76.09 billion, and we get for every $1 in assets that we have, or I'm sorry, for every $1 in liabilities, we have 1.001709 in assets. So assets covers a little bit more to liabilities. Now, this number changes if we take out the inventory. And again, for a creditor trying to find out if you could cover your liabilities, a creditor, if your inventory becomes invaluable, then a creditor may say, well, I don't really want to count that inventory. For example, what if you're selling something that is immediately lost popularity? Like, I can't think of anything off the hand, but let's say something that's a little bit dated, like cassette tapes. If you had an inventory of cassette tapes, of course now they're vintage, but maybe 10 years ago they would not have been so exciting to manage it. So by taking off the inventory, if the inventory loses popularity or it's a product that's not moving, and management wants to know, hey, what do we really have to cover the liabilities? Then we'll use the quick ratio. So to do that, again, we're going to take the current assets, 76.22 billion, and we're going to subtract out the inventory, 2.45 billion. Then we're going to divide that by the liabilities, current liabilities, 76.09. So I'll just take these two, and I'm going to use the cell reference function just by clicking on the cell to divide these two, and you get 0.96951. That means for every liability out there, our assets less inventory is a little less than $1. All right, so the last question is if they had a quick ratio of 0.66 and a current ratio of 0.90, what would you say about the asset liquidity of Apple current relative to Hewlett Packard. Just thinking out loud, I would say that asset Apple's ability to pay stuff back, they're a little bit more liquid because they have a higher current ratio and a higher quick ratio. So short term, Apple is in better shape. All right, so let's take a look at the next problem. And again, I'm trying to make sure I got my share here. Practice 2-23. Now, again, I wrote them all out, and then so I'll be working with you again on the side, but you have the main practice here. Local company has sales of 10.0 million and a cost of sales of 6.0 million. So what it's saying is for every $10 that you sell, it costs 6 million in their expenses, product expenses or cost. To put those sales together for whatever it takes to achieve a sale, either product, service, cost, or whatever. It's selling general and administrative expenses. Those are the expenses that are not directly related to the product or service. For example, administration, HR. Selling expenses are what you pay to deliver the product, either through sales personnel, it's usually sales personnel, or other expenses related to the sales department. The research and development of the company is how much it costs to produce new products. I'm sure you heard a lot last year about research and development in pharmaceuticals, specifically to the pandemic. So the cost to bring a new product or service to fruition. Depreciation is the cost of the wear and tear on the fixed manufacturing good or manufacturing machinery, building, and so on and so forth. Got a little bit of sun in my eyes. Sorry about that. And then the tax rate is what you pay for all this to the IRS. All right, so let's walk through this problem together. We have let's start with the gross profit and gross margin percentage. So for the gross profit, we're going to take the sales less the cost of sales. So I put the sales up here as 10 million, right? The cost of sales, it could occasionally cost of sales if it's a service place, cost of goods sold if it's a manufacturing, is 6 million. The gross profit is 4. So we should subtract these, right? I should say less cost of sales. Get the gross profit. And I'll just copy this over here so you can see. All right. So there is my sales. 10 minus 6 equals 4. All right. So 4 million in gross profit. All right, our gross margin percentage is going to be what our gross profit is in relationship to our sales. And I use the word in relationship when I talk about percentage. So if you're doing the division, it's like the top, what it is, right? What my gross profit is in relation, divide by sales, $10, or divide by sales. And then if I did originally, before I forgot to turn my camera, I got 0.4. I just click the percentage key to get it to change to percent. This operating income is a little more tricky problem, but not too much. First, I take my sales, which is 10 million minus cost of goods sold or cost of sales. And I got my gross profit, right? So we've already done this. This is from earlier. I'll just put a little, okay. Then the next thing we're going to do is we're going to take that operating income that we had earlier. I'll just do a quick top and bottom. Top and bottom border. And I'm going to get 50. And I'm going to take that number and now I'm going to subtract a few more things from it. I'm going to take less selling, general, and administrative expenses. And you'll note that I put this in millions on the left and in thousands of dollars on the right, or in the regular form. So if you wanted to see a shortened version, and a lot of times when you see financial information presented to the board of directors, it's always presented in millions. So it's a good idea to get into that habit. All right, so I put this as $500,000 and it's 500,000. Depreciation. Oh, and I forgot to do this on my first example. Let's do it on my second. There we go. Right, R&D, 1 million, and we're just subtracting these things from this original gross profit. All right, when we do all that, we get an operating income. We subtract 4 million minus 5 minus 1. We get operating income of $1.5 million. And then the last thing we need to know is what are we going to get after we pay the IRS? So we simply take that 1.5 million, multiply it by 35%, and then that gives us our net income. All right. In practice problem 3-3, we have an interesting scenario. Our employer is going to give us a choice between a $5,000 bonus, 100,000 shares of company stock. So what they're going to do is they're going to say, hey, you want the money as a bonus or you want the shares of stock? Well, you don't know what you're going to get in shares of stock, right? Unless you calculate it through. So in order to do that, when you have two similar scenarios and you have to make a choice, it's good to map it out on paper and compare them to each other. So first scenario here, and of course, I'd already did the answer early. Sneak peek, spoiler alert, right? I'll just go ahead and hide these. First thing I'll do is I'll look at 6,300, which is going to be the amount of $63 in stock times 100 if I sold it today. 5,000 is what I could get from the employer if I didn't do the shares of stock. And of course, it's at 63 and sold it today. Which would I rather have? I'd rather have the 6,300. So I'll take the shares of stock and sell them. The second one is what would happen if now you can go ahead and get the 6,300 and you're in the same choice scenario, right? 100 times 6,300, but now you got to wait for a year or take 5,000. So I will just tell you right now, what would your decision depend on? For me, it would depend on whether or not the stock was volatile. If it was Amazon, I'd probably hang on to it and just take the gamble and wait a year. If it was some cryptocurrency, I'd just go ahead and sell it right now and take the take the 6,300 or 100. Or I'd take the, I'm sorry, bite my tongue. I would just go ahead and take the $5,000 bonus because that stuff has been all over the place. So a lot of it depends on the stock that you're getting and more than just the dollar amount. But the purpose of this exercise was to show you how to do two scenarios together. All right, so the next one is a local electronic store is offering a promotion 1 year, same as cash, meaning that you can buy a TV now or wait a year with no interest. So there's a point to all this, and that is that you never are in a situation where you don't pay interest. You're always going to pay a little interest for something. It could be that you go down to the company and they say, okay, well, if you wait, let's do this right now. If you wait a year, you could get the $1,150 TV, or you could pay $850 right now, right? So usually, and that would be a different scenario, but usually someone isn't just your best friend letting you run around with a free couch for a year. They charge in some sort of financing fee to waiting a year before they can collect. Someone gets a financing fee. So you may not know what that interest is, but in this scenario, they said that you could go to the bank and get 4.3% interest. What's the true cost of the TV to you today? So let's assume that they are back charging 4.3% interest. So we use the present value calculation. And that means you want to know what's it worth to you today if you have to wait until the end of the year. So the present value calculation works like this. You take the rate 4.3%, the number of periods 1, because you're only doing 1 year. There's no payment because you're not getting anything. They're not getting anything until the end of the period. The future value of the TV at the end of the year is $1,150, and then put type end of period because that's when you get the TV, and you get this number. This is a negative number. It's in the little parentheses, red, negative 1,102.59 cents. All right, so we're just going to come over here and flip the sign. You're going to want to flip the sign and make it positive for your answer. And what it's basically saying is if you symbolically went in and offered them $1,102.59 in cash, they would probably take it because that's the implied interest that they're paying over a year for your financing, or same as cash. All right. So let's go ahead and look at the next one. The next one gives you three scenarios. And this is problem 3-20 in the book. And this says, this is a great little problem to kind of do these what if, like, I love this one because it's like, how long should you wait until you get some money? All right. So here is the scenario. Let's say you get the following situations. You get $100 if you wait a year, $200 if you wait 5 years, $300 if you wait 10 years, and then assume that the interest rate is 10% per year. So while you're waiting, you could have been earning, if you'd had it today, you'd been earning 10% per year. Okay. So it's going to be less because you have to back out that 10% per year, assuming that you could have done something with the money. It's not worth as much to you now because money loses value. Just like it was 5 cents for a cup of Coke in the 1950s, and now it's $3. I went to a restaurant this morning. It was $3.25 for a soda. And I was like, wow, that's a lot. Okay, so what we're going to do here is we're going to do the present value calculation again. And we'll come in here and do it for each one. So I'm going to go ahead and do this really quick over here to the side just to show you. The present value is rate 10%. Number of periods, this one is 1 year. Payment 0. Future value is going to be 100 because you'll get it in a year. And the type is ended period. All right. That gives us what it's worth to us today, $90.91. And then, of course, you can see I did that over here. And I'll pull this out so you can see it. All righty. Next one is going to be what would happen if you had the same scenario, only now you have to wait 5 years. So would you rather have 205 years? So I'll go ahead and do the rate, 10%. Number of periods, now we're at 500 or 5. We got to wait 5 periods to get the $200 payment. Nothing. We're not getting any money. Future value 200, type 0. And there you go. $124. And I said again, what it's worth to you today is not a negative amount. It's worth $124. All right. And then as of today, we're going to do 10%. Number of payment, number of periods. This one's 10 periods. Payment is going to be 0 because we're not getting money until the end of the 10 years. 300 future value, ended period. And there we go. And again, that shows you the different amounts. So we look at the ranking here. Obviously, we want the highest present value of the highest scenario, what is worth to us the most. That's going to be scenario number 2. On the podium here, we have scenario number 2. Best case scenario for us is waiting the 2 years or 5 years and getting 200. 310 years is a little bit less. And then waiting 1 year to get 100 is the least case scenario to us. And again, you could say also, assuming if that interest rate's not fixed, that could fluctuate around. There's a lot of things that could go into the scenario. Maybe you don't trust that person is going to make it 10 years to give it to you, or whatever scenario is going to make it that long. So the risk goes up as it goes longer. But for today's purposes, we would take scenario number 2. So you can use these rankings. Again, rank it in B, you change the interest rate to 5%, and in C, you change it to 20%. The last problem is present value of 1,000 paid at the end of the year of the next 100 years if the interest rate is 7% per year. All right, so this time we're getting $1,000 for 100 years. Kind of sounds like a lot, right? And we want to know if we wait $1,000 to get, or I'm sorry, 100 years and get $1,000 each year, what is that actually worth to us today? And the fun thing about this problem is you can think about how important it is saving today for later on. Because if you have any interest rate at all, whatever you save today is going to be worth more to you today as we go forward, and it continue to grow. So you can put a little bit in today and it can grow to be a large number and go on for quite a while. All right, so what is it worth to you today? The first thing we're going to do again, and we're going to take the present value calculation. All right, the rate here is going to be 7%. And I never try to use the decimal. I never try to move it because that is a recipe for mistake. The number of periods is 100. The payment is 0. The future, the payment, bite my tongue. The payment is 1,000 because we're getting 1,000 at the end of each year. There's no future value. There hasn't been given any extra value, like we're not going to get a bonus at the end. Too bad. I'm sorry. And then at the end of the period, and we're going to close it off, and that's what it's worth. And then, of course, I went ahead and changed the sign to positive. Enjoy your practice problems this week. Make sure you work on the homework, and